Hey everyone, this is Daniel here from Appreciation Capital. Um, in today's video, I'd like to talk about the current market condition and are we close to uh, the Judgment Day, which I refer to as a Judgment Day, as in are we close to a major correction in the market? So recently we've seen quite a bit of volatility in the market, a pretty huge swing since the 2015, and these swings are actually they're pretty large. They're around 8 to 11%. But uh, the Judgment Day I'm referring to will be a correction in a magnitude of 20+%, like this one, or something like this, or something like that, right? Or like 2008. So is the Judgment Day coming? So first of all, I'd like to look at the big picture here. Since 2009, we have not had any correction more than 15%. So all these corrections have been smaller than 15%. And it's been how many years? It's been almost 10 years. Actually 9 years, because this is 2009 March, and we are at 2018 March, which is 9 years. And for 9 years, we have not had a major correction in the market. Okay? And basically, a lot of people who bought over the 9 years have made a lot of money, and they could be potential sellers at this level, right? I'm just looking at the market logically speaking. And in my previous video, I talk about the potential path of price in the market for a certain period. So if you go back to my previous video, I explained what the potential path of price for the market is. And in this case, back in 1983, we can see that in hindsight, the potential path of price can be actually discovered in the market between 1983 to 1984. This price range actually determined, you can actually infer this and figure out the potential path of price. And this path of price has been followed by the market for a very, very long time until late 1995, the market actually broke out and left this potential path of price behind. When I'm looking at this potential path of price, it looks like gravity, right? It looks like the Earth's surface, and the stock price, the price is always trying to escape from this level, but there's gravity, right? It's always trying to pull the price back down, and the price goes into that range again, pulls back down, price goes in that range again, which couldn't escape until the market has accumulated enough energy or enough capital in the society, and eventually we broke out, right? And this potential path price actually, you can see that eventually the market actually came back in 2008, 2009, and it touched that price range again. Pretty interesting stuff. And my hypothesis of the current potential path of price, if I'm using the chart from 1987, I would think maybe the current path of price could be determined by the price action from 2004 to 2008. And I've determined this thing, and you can see here, this path of price is across this consolidation area, right? And I think this consolidation area, just like this, validates that this path of price does exist. And now we are actually way above the potential path of price, right? Just like right now, just like here, we're way above it, and it's very likely. I mean, just based on this market geometry here, that we could have a correction that that comes down, and it's just a mean reversion, right? So the question is, when this is going to happen, and how quickly this is gonna happen. Like, what's the speed of correction, right? If the correction is like this, you still have a lot of time to get out. You still have a lot of opportunity to get out. If the correction it's like this, right? You have almost no time to get out. You have to be able to get out beforehand. However, if the correction is like this, it's gonna crash. Then it's a very good opportunity to short the market, right? You could literally make, with a leveraged product like options or volatility index, you can make 10x return in a couple of days. So this is like a trade of several decades, right? If you can catch this kind of opportunities, you can increase your portfolio value by tenfold pretty easily if you're able to time it perfectly. That's the assumption. So timing is actually very difficult here. But if we look at the chart here, what you see here, I'm just looking at the weekly chart with the 3-day chart of 1987. It seems we're making a pretty similar pattern. We're making a very similar pattern, right? And just gonna clone here. You can see that we're making a very similar pattern. I'm just gonna turn that into daily. Right? So, where are we now? So if I just draw these two trend lines, this range here, you can see that we have the chart looks kind of different, but let me show you something. What I noticed is that if I just cover this up, you see that? We have a high. Let me bring this to the front so I can cover this up. We have a high, we have a low, we have a slight high. We have a high, we have a low, we have a slight high. And we have a gap kind of down. We have a pretty fast price move to the downside and bounce back a little bit. Then it went to hell. We have pretty fast price move to the downside. And maybe we're gonna bounce back a little bit to maybe fill the gap, and we're gonna maybe completely break down. So this is just my technical analysis. I mean, I need to back it up. This is just my timing analysis, right? I need to back it up, maybe with some fundamental analysis. So I use this something called Simply Wall Street to to do some screening for a bunch of companies and looking at their fundamental data. And so this website is pretty nice. It basically shows the companies in a visual way, and it shows where the value is. And this website used I think it's using I think it uses some sort of a cash flow analysis, future cash flow analysis, interest value based on future cash flow. And so it's based on the future cash flow, and they have an algorithm, proprietary algorithm to analyze all the companies. Of course, when you apply a future cash flow value analysis to a company, it's not a analysis method that can be applied to all the companies and give them all a fair valuation, to be honest, because some of the companies, they have a higher growth rate. And regardless, it's still a pretty conservative ways to evaluate a company. Okay, and given the current share price, what's how is the company undervalued or overvalued? So when the company is undervalued, you will see something like this, right? You have a pretty high value here. Sorry, you have a good value here for you to buy. You want to buy some company that's undervalued. It's green in this area, and the company that's not undervalued, that's overvalued. For example, this Cisco system is a pretty famous one. Is overvalued. The future cash flow value is about 37. Is overvalued by maybe 30%. Okay, and what I did here is basically order the market, order all the companies by their market cap in a descending manner, right? I sort them in descending manner, so the company with highest market capitalization is being listed first. The reason I'm sorting this way is because S&P, all the large market cap companies are actually part of S&P or part of NASDAQ. They're part of the index. So these companies consist of this index, right? I mean, Apple is part of S&P, but Amazon is NASDAQ. Anyway, so S&P or NASDAQ, they're pretty correlated. So if you look at all these companies, what you see here is that in this market, I couldn't find, to be honest, I tried, if I'm a value investor, I look into this market, I could not find a single company I could invest. Like every single company is overvalued. Every single company, every single one is overvalued. And just look at any of the stock, right? If you go, do a search S&P composition on Wikipedia and just look at all these companies in the S&P, just pick a company at random. Like let's just pick a company at random. Like AAP, I never even heard this. Advanced Auto Parts. What is this company? You can see that all the companies have a trajectory like this. Maybe this auto parts company are not high tech. Let's see, maybe there's other companies. Align Technology. Yeah, Align Technology, I know is up. Maybe Alliance Data System, ADS. What is ADS? You see. So you see all these stocks, all these companies are actually hovering around a very high level, right? The famous one like APL, Apple. Apple has been up for a long time. Google, right? All these companies have this kind of parabolic. So basically, it doesn't take a genius to recognize none of the companies at the bottom, obviously, and all of them are pretty much at their all-time high, and they're consolidating. So if you guys know what a stage analysis is, I think for these companies, we're probably at a stage 3, which is distribution, and I think stage 4 could be right around the corner. I mean, these situations are perfect for stage 4. So let's think about this logically. We have a lot of funds, right? Market participants, they're buying these companies over the years. For the last 10 years, there's barely any volatilities going on in these companies. And now we're seeing a lot of volatilities at the top. We don't know if this is the top or not. We don't know. Maybe this thing's going to go even higher. But let's say this is the top. Let's say this is the top. And let's assume this is the top. And I want to kind of figure it out, logically think about this. Can we logically infer what the decline is going to be? Is the decline going to be very smooth decline that people just sell off gradually? Or the decline going to be very rapid? Because once, it dropped down to this level, a lot of people who bought here, they are still in profit. They will likely sell. They will panic, right? And the people who bought here, they're gonna panic to sell. So it's very likely, in my opinion, that the market might actually crash. It's not gonna be a much more order sellings like 2000, maybe early 2008. I think because it's making this pattern already, I think the fate of the market could be already sealed. That a rapid kind of a decline, it's just around the corner. It could happen next week actually. So my prediction is that my opinion is that it could happen the week after next week. So next week we will see maybe several decline here, and the Black Monday scenario could happen on the Monday of April, I think. What day is today? Today is March 23rd, so because we have 30th, the market is actually closed. Good Friday. So Monday, the market's going to be resume open. So April 2nd could be a day of reckoning. Let's see. I want to see the holiday schedule. I know Good Friday, the market definitely does not open. I want to see the Easter Monday. Okay, Easter Monday, the market's open. All right. So be careful out there, guys. If you see something like, like this, like, tomorrow, if tomorrow it bounced back, like this, it could be a bull trap, right? It could be a bull trap like this, and it's going to trap a lot of buyers, and then we have a really swift decline. So this could be a bull trap, and we should use this opportunity to use that bounce to short the market, or stay away, or liquidate your positions, and go maybe for all cash. I rarely suggest people to go all cash, but this kind of patterns that's been forming in the market, maybe you should go all cash, right? You might bounce back, fill the gap tomorrow, which is Friday, and don't be fooled. That's the bull trap, and next Monday it's gonna start to decline until maybe Thursday, and Friday we have a holiday, then the Monday after that, Black Monday. So I don't know. That's just my prediction. But on the bullish scenario, so this is a bearish scenario. On the bullish scenario, what is safe? On the bullish scenario, if where's my drawing tool? It bounced back. It came back and hovering around this area. If it does hovers, it doesn't break down. Like if it bounced back, as soon as it bounced back, the next day it breaks down. That's definitely like you need to get it, right? If you're in that trade, if you're long in the market. If it hovers around, and you should maybe enter here when it hovers, then the thing's gonna keep going up, right? Just like this, it bounced back, hover around. I mean, this situation could happen, right? It is exactly the opposite. Bounce back, hover around, right? Then we enter here. We just enter, and the market's going to take off. So that would be a bullish scenario. The bearish scenario, but when the first bounce back, you don't want to go long the market here. Absolutely not. You want wait for this to pull back, consolidates, then go long. Okay? All right, thanks for listening. I know probably nobody will see this video. I have a new channel. This channel is new, and I have no subscribers. So if the market does crash, you're probably going to see this video way after that. But if you do see this video, well, prepare yourself. Good luck.